benchmarking, and I will turn it over to Brad.
If Adam and I are Mr. Boot Camp, Kate is Miss Boot Camp, clearly. I would probably recommend you take your books. One of the problems we've had in the past is that the housekeeping people will keep the books here, but they won't end up where you sat last time. And so your book with your notes ends up on the other side of the room, and that we've had that happen before, so I probably recommend you take it. Or make sure you put your name in it for sure. It's funny, Dustin said you're gonna hear him for 3 hours. There's not that many benefits of getting old, but one of the benefits, besides grandchildren, is Dustin is going to do this for 3 hours, and it used to be me doing it for 3 hours. It actually used to be sometimes Adam and I doing it for 3 days before we were able to get the great group of speakers we have. But, I've learned over the years now, Jeff, I'll point at you. I feel like I taught you everything you know, and now you know way more than I did. Now I call Jeff when I need advice. So the group that we have speaking is a great group of younger folks who really know their stuff, and they know it better than us older folks these days. So I think you'll learn a lot. This is a session that we've kind of morphed over the years into a variety of financial topics, and I added something to the beginning of it this year. I kind of added a little bit about restaurant CFOs. I did a presentation at the Restaurant Finance Conference in November, and it was called like the modern CFO, sort of how CFOs' jobs have sort of evolved over the years. And I look back what my job was when I became a CFO in 1984. I didn't probably have a clue what I was doing, and I didn't have a conference like this. But I did go out and meet a lot and created a list of mentors, and we'll actually talk a little bit about that, who helped me enormously along the way. But I thought it would be fun to maybe spend 15 minutes and we'll walk through some of my thoughts on kind of how CFOs have evolved and what I think are really important aspects of your jobs. For you non-CFOs in the room, you can go back and say, hopefully you'll say, this is what I want you to be doing. You need to do more of this. I've always said the job description of a restaurant CFO, which was my job description at Houston's, is I did everything no one else wanted to do. Because if I didn't do it, it wasn't going to get done. So my job was to figure out everything that sort of had to get done, who was doing something, and then I sort of had to pick up the rest. And I don't know about you guys, but I found in my career that when I tried to shove things I thought other people should be doing, it didn't go real well. Operations folks really don't want to get involved in legal HR issues. I used to say the two best things that ever happened to me in my work career was when we hired in-house legal counsel, because I no longer had spent 50% of my time on legal and HR issues. Or when we hired in-house IT, because, Lord knows I really didn't know what I was doing, and those were the early days of technology, and it was a lot simpler then than it is today. But what makes this business really hard is it's not a simple business. Maybe those of us that have been in it a long time think of it as relatively simple, but it's really all these businesses wrapped up in one. It's a retailer in the sense that you're going and you're leasing sites and you're opening to the public, and that's our general way we sell stuff. But we also are a manufacturer. We buy, we have unfinished goods, we manufacture them. Some of them are halfway manufactured at the end of the day. We assemble them. It's really manufacturing in many regards. And service, clearly. And we used to always say at Houston's that we were also, to some degree, in the entertainment business. That to some degree the whole restaurant thing kind of had to have a bit of an entertainment aspect to it to be a place people wanted to go. So it's all these industries in one. Consider the following. When I started in the business, it really wasn't uncommon to have labor percentages as low as 20%, believe it or not. Our margins were higher than they are today. Our investment in new stores wasn't nearly what it is today, so our sales to investment was different. We'll talk about that. And our return on investment is different, but all that's really changed, over the last 20, 30 years. This is what we're kind of seeing today. Labor is a good 10 percentage points, I guess you'd say, higher than it used to be. Margins, good 5% lower. Tough to make capital go as far as it used to. And clearly, return on investment is nowhere near what it once was. And we've noticed, and you guys probably have too, that the private equity firms used to always say, no, we want 30, 40% on investments. And while they still do, I think their threshold has been brought back to reality to a large degree. Finding those kind of returns is not nearly what it was at one point. The world has changed very rapidly. I don't have to tell you what the failure of Lehman Brothers meant to the economy. Food costs can change overnight, right? The cost of cheese, the pizza companies have reported, went up 25% in just April. Beef prices, Chipotle reports, went up 25% in just April. So things can change very quickly. Labor costs, mandated health care. I've always felt over the course of my career that labor has been the biggest challenge to the industry as opposed to the food end. And while the food end can now be very volatile, I still continue to think that over long stretches of time, we're very efficient in this country at making food. So the food aspect, I think, is not really where the long-term challenge is. I think the bigger challenge is the labor aspect. And whether you're a Democrat or Republican, I think at the end of the day, we all sort of share a common belief that in this country we take care of people. And we do. And that therefore people are expensive. Don't have to tell you what tainted taco shells did to Taco Bell almost immediately, instantaneously. And when it comes to sites and deals, although real estate, has had a bit of a recession as well, for those of you that are involved in the real estate side, and I was for years in Houston, I did all the real estate, and with many of our clients, I still opine on real estate. They'll say, well, what do you think of this city or that city? And I'm pretty familiar with most cities. The good sites and deals go quick, and you have to be very prepared. So things change very rapidly. In the old days, just to be a restaurant CFO, you had to have some basic talent, and you had to be an honest person. Do those two things, and who said it? Then you're in food and accounting. The separators, I think the ones that were the better, best in breed, love the game, were very street smart, well-rounded folks, good business people. Oh, Case McCabe, Slick. Now, I think what used to be the separators is now just first base. The fundamentals. You've got to really like this game. You've got to like, I love that phrase. Who said it? Food and accounting, two best things. This is great. You got to love food and accounting. You have to be a well-rounded business person. You can't just be a CFO. You sort of have to be a business person as well. I think that's just the starting point today. I think the separators, and that's what we'll spend the next couple minutes talking about, are those that are the most prepared, have the ability to really prioritize, because we all know now with the sense of urgency and the number of emails we all get and the way things change so quickly that we have to make an unbelievable number of decisions quickly, and knowing which ones to make, which ones to delegate is a really important thing. I say being on the right side. I'll give you an example in a couple of minutes, but knowing when you should be a buyer, knowing when you should be a seller, knowing how to be a seller in a buyer's market, knowing how to be a buyer in a seller's market, those kind of things make a difference. And having a good mentor group, knowing some of the folks in the room here, we've all dealt with this, and our ability to impart some knowledge to you guys when these situations come up is a good thing, but it makes all the difference in the world being on the right side of the transaction. And being a difference maker, no excuses. One of the things I learned early on at Houston's was excuses really don't fix anything. They might explain what happened, but they don't change what happened. And we were looking for change makers and not excuse makers. So while we didn't necessarily assess the blame to you, we are looking to you to solve the problem. And if you can't do it, we'll find somebody else that can. One of the things that George Beale was fond of saying was, I can't change a whole lot of things, but I can change people. And so an early lesson I learned in my career. So the faster pace of business is what's driving the new things that CFOs have to make priorities. Making decisions quickly. I think the ability to make some of these decisions quickly is really, really important today. If you've got food prices changing 25% in a month, you can't just, well, you can just simply absorb it, but that's not going to be the best way for the companies to handle that situation. Knowing how to change ingredients and products and menu items and menu prices, I think has become really critical. If a client says, well, we change prices every quarter or every 6 months, we look at new products every quarter, every 6 months, the first thing that pops into my mind is, no, this is an ongoing 24/7 thing. Sometimes you have to change products every day. One of the things that one of our clients did is they had a specials card. And so they would hand it to the customer, and it had like 1 chicken, 1 fish, 1 meat, and those were sort of the items that they used to sort of, not only provide a special, but it also was items that they were sort of testing. And if people liked them, it would become a staple on the menu. Well, one of the things that I suggested was, look, if it's not a good time to sell beef, instead of having 1 beef, 1 chicken, 1 fish, why don't you put 2 chickens on there, maybe not even have a beef. And we all know that these special cards work. We used to do a session on menu engineering, and we haven't really done it now, maybe a couple of years. But menu engineering is a very powerful tool, and it really works. And if you all have special cards or have ways that you are promoting your products, then you know these things work. So I say, being attuned, sell what you want to sell, knowing that prices and ingredients and those kind of things are changing very rapidly. So I think the ability to adapt really quickly is really important. Underperforming locations and underperforming personnel. Again, one of the things that we used to say at Houston's is that I can't change a lot of things, but I can change the general manager, and they can make a difference. So I think dealing with underperforming locations and personnel is really critical. In terms of underperforming locations, John Hamburger, who runs the Restaurant Finance Conference, has always said that something like 20 to 30% of all locations in our industry probably should be closed. He's probably right. And I've heard every excuse in the world about why you're not going to close that store. It's turning around, or it's what we use for training, or it covers overhead. I mean, I've heard everything in the world. I tell you where it becomes real dollars and cents is when you're ready to sell and you've got those low EBITDA or negative EBITDA stores. And trust me, when you start to try and figure out how that's impact the value, or when the buyer of your business starts telling you how that's impacted what they're going to pay you, then you'll see the significance of dealing with underperforming stores really quickly. If a store loses $100,000 a year and somebody's paying you 6 times for your business, then they've reduced your purchase price by $600,000. If you could close that store and maybe negotiate 2 years worth of rent at say $200,000, then you will have increased the value of your company $400,000. While nobody wants to pay extra rent, those kind of decisions, you tend not to think of those decisions as a multiple. But when you get ready to sell, everything's a multiple. So making these kind of decisions is really critical. I think I mentioned when to buy, when to sell. Right now, in particular, it's generally a seller's market. Values are pretty high. We're seeing deals, and we've seen lots of deals in the last 18 months or so. And we're seeing deals in the franchise space that, not that long ago were probably in the 4 multiples. Now our every deal we're seeing is probably 5 at a minimum, sometimes 6, sometimes a little over 6. In the independent space, multiples are through the roof. If you've got an independent concept that shows the potential to be successful in multiple markets, has all the things we're going to talk about for the next hour, we've seen multiples 10 to 20 times. So it's clearly a very good market out there from a seller's point of view. Financing is very available. Financing is as cheap as it's ever been in my entire career. So the modern CFO has to be prepared, needs knowledge leaders, and has to have available tools. And I'll talk about each of those. Being prepared. To me, one of the more frustrating things as being an advisor to your companies is people say, well, I've got projections, but when I say, okay, give it to me right now, they don't have it. And I think it's really important that companies, so not only are you on top of where you are today, but are on top of sort of where you're going. And so I always maintained pretty much an ongoing set of projections for a couple of years. They were always looking out about 2 years. And I chose 2 years because it took about 2 years to really see a Houston site from an idea to opening. Because it takes a long time through the development process these days, especially when you're doing business in a Florida or a California where you've got the whole site plan approval process, et cetera. It just takes a long time. I didn't want to commit the company to an expenditure 2 years from now, and I didn't have a slightest idea where the money was going to come from. So I wasn't going to ask anybody to sign a commitment unless I knew where the money was going to come from. So I was always kind of looking out a rolling 2 years. I think most companies don't do as good a job on maintaining these projections. They don't have to be that complicated either. I really think most of you tend to overly complicate the projection process. Don't get me started on what you do with budgets, because I could spend the next hour probably lecturing on your budgets, most of which I probably don't like. Tell you that right now, and probably spend way too much time on. But it doesn't have to be. When you think about it, really, how many, what figures are really that important in our business? Number of stores, average volume, same store sales, maybe food costs, labor costs, a handful of other costs, our cash flow, our capital expenditures, our debt repayment, taxes. That's about it. I mean, there's 15 items maybe, so it's not that hard to project all these and keep them relatively current at a high level. It doesn't have to be that detailed, but you'll always have a sense of where you're going. I'm not sure if you talked about some of the closing benchmarks, but and so I'll tell you, and then if it's a repeat, it's a repeat. But we've done some surveys, and we found that the best in practice are closing their books within about 1 week. The average in the survey, there were about 100 companies that we surveyed, restaurant companies, were about 2 weeks. I say 2 weeks, I mean 10 business days. And we've got clients now who are really able to close in about 3 or 4 business days. It really can be done. It requires a lot of checklists, a lot of some estimating, but with a commitment to the process, you could have real-time numbers very quickly. one of the early lessons I learned within a month of starting as the CFO was I was told they want some analysis on our restaurant. So after we closed the month, after like 3 weeks, I worked on all this analysis and I handed it over to the president of the company, and he doesn't even look at it, he rips it up and throws it down. He says, I need it in 1 day. So, he was setting me up here. So the next month we close, takes like 2 or 3 weeks. I spend 1 day, I analyze everything, I give him the report, does the same thing, rips it up, throws it away, and says, I want it 1 day after the end of the period. Because, by day 2, I'm on to the second period. And so I learned very early on in my career this whole operation sense of urgency kind of thing that I'm sure you all know about as well. So speed, I learned about speed early on in my career. So being on top of the accounting process is critical, and hopefully a lot of the stuff we'll talk about in the next couple of days will give you a lot of good tools to make that process go quicker for you. And benchmarks, which we're going to hit now, and conferences like this, and really for you to learn how to do your own benchmarking is really not that complicated. Having knowledge leaders, I think this conference is a good start. Mentors, using good professionals, using law firms that understand your business, and CPA firms that understand your business, will go a long way to helping you guys. There's all kinds of technology tools, and Bill, you're going to talk about technology. I don't know if you're going to hit ideal food cost, but then that always comes up at some point in the next couple of days. Will be ideal food cost, menu engineering perhaps. But I'm going to hit one in particular right now, and that's flow through. Is there anybody here using flow through? Okay, so maybe 6, 7, 8 people. There was a time when I'd ask and there wouldn't be a hand in the entire place. So we're making some progress here. Let me explain it this way, because once the light bulb goes off in your mind and you get it, it will be a little bit of a, I don't want to say life-changing moment for you, but you'll have really understood an important concept. But it takes a little bit before it finally sinks in exactly what this is, because at first it's a little bit mathematically confusing. Let's suppose you have a table of 2 people in your restaurant. And let's say that you could magically make that table of 2 people, 2 customers, be 4 customers. How much additional profit will you make on those extra 2 customers? All right. Well, most of your costs at this point are already fixed, right? The reality is about 70% of your costs are fixed. Your only variable cost on those extra 2 customers is likely only your food cost. Right? So 70% of your costs are fixed. Your profit on those 2 additional sales is 70%. It's not your 10% bottom line, it's actually 70%. Okay, this concept's called flow through, or profit at the margin, and it's really not your overall profits, but your profits on that very last sale, or the last 10 sales, or the last sales over last month. It's an incremental thing. 50%. Let's say that you have a location and it's located right next to the arena. And let's say that Super Bowl, what are we up to, 56 or something? Super Bowl 50-something is going to be in that arena, all right? So your business will double that week. How much additional profit will you make on those additional sales? Well, it's no longer 70%, because now when you stretch the time frame, or you know about it in advance, you're going to change. You're going to have more employees there, you'll have more servers, you'll incur more expenses. So the more you stretch out the time frame, or the more you're aware of something changing, you will change too. So your profit may be more like 50%. Well, what if your sales in a store, let's say coming up with some goofy examples. The arena was closed, they built the new arena, let's say, and a year ago you didn't have the arena, now there is an arena near your store, and your sales go up. What's your profit on those extra sales? Over the course of about a year, we found that the profit margin is about 40%. And that's pretty much the typical rule of thumb that you should use for learning about flow-through, is about 40% over any kind of reasonable period. We're not talking about the next sale, we're talking about sales in a month over the prior month, sales this year over last year, that kind of thing. Over the course of, say, 8 or 10 or 15 years, so let's say that 10 years ago there wasn't an arena and now there is, what would the additional profits be over that long stretch of time? Not a year, but 10 years. It's more like 20%. Because other costs tend to creep up. Your rent goes up over time. Utilities go up over time. Credit card fees, perhaps. That kind of thing. Not CPA fees. Here's a flow-through example. I chose kind of maybe a fairly typical TGI Fridays as an example, because there actually are some TGI Fridays groups that we have done this for many times. But let's say store 1 is a high volume store, store 2 is a low volume store, and the average is the average of store 1 and 2. Or just pretend there's 30 stores and that's the average, okay? And there's the controllable income. In this particular example, we used controllable income as the thing that we're gauging or measuring. It doesn't have to be. You could use EBITDA, you could use EBITDAR. You can pick what subtotal is real meaningful to you. In the casual dining world, controllable income tends to be the thing that operations has determined that the manager is primarily responsible for. So this particular client likes us to focus on controllable income. In this example, store 1 had sales 500,000 greater than the average store. Store 2 has sales 500,000 less than the average store. Store 1's controllable is 100 greater than the average store. And store 2's controllable is 150 less than the average store. So what we do is we calculate or divide the change in controllable over the change in sales. Excuse me. So we're dividing this by this. Okay? So what we're measuring now is what was the additional profit either made or lost on those additional sales that we either had versus the average or we didn't have. And what we find is store 1, its flow-through is 20%. Well, if you remember from this page, 20% was a 10 or 12 year thing. We're looking at, right now, I'm looking for 40%, not 20%. So if I've got store 1 who really ought to be pretty consistent with the average store except for the higher sales, I'm looking for about a 40% flow through. So store 1, who probably might have a higher bonus for the manager, is generally considered the better store, in my mind, is probably not as well run as store 2. Store 2 is the lower volume store, probably gets picked on, manager gets a lower bonus. In this situation, it's actually better run than store 1. Their flow through, while negative, is less than 40%. So they managed a bad situation better than the other store has managed a good situation. So flow through can be a very powerful tool, another tool for you to help analyze your stores. And I recommend that you use it. Some of the larger chains are not doing it. I believe Chili's, Cheesecake, for example. We have a lot of clients that have built this right into their income statement. So when the income statement prints, they'll actually have the flow through right at the bottom. And the common ways to do this are you can compare Sometimes when you do 1 month, you get some weird results. Because if food cost spikes 25% in 1 month, when you compare that month to last year, it's going to look really odd. It's going to look like you did a crappy job when you probably had very little time to react. So using year-to-date tends to be a little bit smoother. However, if you compare that one store in that 1 month to all the stores in that 1 month, then everybody had the same disadvantage in that food cost. So you've removed that aspect. Now you have a pretty good gauge to see how the store is handled compared to all the other stores.
Do you prefer months, periods, 4, 4, 5? Which configuration do you like?
Question is, am I a monthly guy or a 4, 4, 5 guy or a period guy? At Houston's, we were actually months. And when I first started doing this, I found nobody was months. But almost, it's got to be 95% of our clients does, and maybe even higher, are on periods. We have maybe 1 or 2 out of a couple hundred clients that are still months. I sort of am a 13-period guy, but I'd say most of our clients, I think we may have benchmarked this, but I don't remember, 4, 4, 5. I think most of our clients are 12 periods, 4, 4, 5. I just like 13, but that's me. But I think the majority are 4, 4, 5.
Brad, there's a lot of variables here. You know, the stores can have different rent factors, and there's some, well, that rent isn't a...
Well, controllable income's a good
But
subtype.
I mean, there's different variables of pay cost of employees. There's a lot. And would you look back at prior GMs and what they did, and you can tweak this? This is a good start.
Like any other tool, it's a tool, and what one client does is they calculate it and they call it expected, and then they require explanation, and if the explanation is acceptable, great. But they consider that the starting point. You know, it's like anything else, you get what you measure. And I'm suggesting this is a really good measurement. Because if you want to get 40%, then measuring it is a big step towards getting you there.
What's the definition of controllable income?
Well, in the Fridays world, it's actually called PACE, which I think means profit after controllable expenses. But it's typically after cost of sales, after labor, and after a subcategory of operating expenses that are typically very four-wallish. Credit card fees, operating supplies, repair and maintenance, that kind of thing. It doesn't include rent, doesn't include depreciation, insurance, property taxes, things that are more occupancy related, things that maybe a manager had no control over. So again, it's trying to focus on those operating expenses that, in theory, managers have most control over. But you can use any subtotal you want.
Yeah, as long as you do it on your year.
If you're using a higher level subtotal, I probably would expect a better answer. I'd probably expect maybe a little more than 40. If I were going lower on the P&L, I'd probably expect a little less than 40, because then things start getting a little, there's more likely to be some expenses. The relationship of fixed and variable, while it doesn't change in a huge manner throughout your P&L, other than cost of sales, which is almost entirely variable, there are some differences. But all this really is a exercise in in fixed versus variable. And I'm suggesting, instead of spending a week analyzing your costs about what's fixed and what's variable, I'm telling you these work. I'm going to save you a bunch of time, and just use 40% for most everything. Diane?
Along those lines, one of the things that we changed to was we're doing a flow-through comparing, and we do ours mostly on quarters, comparing what they did this quarter to last year and with the flow-through. And because everybody, well, maybe not everybody's like us, but you know, it's been tough times through this last couple quarters, and our managers were getting frustrated because there's just no bonuses because it was based off of student budgets. And so we decided to do it this way, comparing it to last year, because then you could see, even though their sales are dropping, what's going on with their, we use the EBITDA number as our bottom line instead of controllable income, but you were actually able to see those stores that were dropping their sales, by 5-6%, but their EBITDA was sometimes increasing or just slightly below, and those were the managers that we rewarded them because they were controlling their bottom line in tough times.
Yeah, I could give you a couple analogies. It's rewarding the 300 hitter on the losing team. I don't want to call you losers, but, rewarding the player playing really well during the slump. Another way that really didn't dawn on me until you mentioned it, I think we all know that restaurant people are some of the most, operations people are some of the most skilled people at getting what you ask them to do of anybody I've ever met. You tell them what you want, they will deliver it. But you have to be very careful to tell them what you want, or they will deliver something that you don't want. And just cutting expenses isn't necessarily the right approach. The nice thing about this is it gives you a measurement that's very reasonable. So then they're not, because it's based on the proper allocation of fixed versus variable, that they're not just cutting costs that they should be incurring to get you the numbers you've asked them to get you. This is a way to create the expectation that is both reasonable and not cutting corners. Any other questions on flow-through, because we're going to move on. We're 15 minutes behind. I don't know if that means anything or not. Yes, it does. Oh, I thought he was going to fix it. He looked so confident.
Oh, I'm sorry.
Is it okay?
Oh.
Cancel. She can cancel.
I already told you I wasn't in IT. But my job's not getting years ago.
I just say cancel.
I am, it's not doing anything. I'm trying to be obvious stuff. Yeah, you'll get paid.
We'll know you bring it Adam in.
Yeah, that's probably.
Okay. I didn't cancel. What, escape, maybe?
No, it's canceled.
Where would you be without me?
We're going to talk for the next, what are we here till 2:45? 2:45, I think it is. So we only got 30 minutes. Wow. Next 30 minutes, we're going to talk about some benchmarking and ROI concepts. And just so we're all on the same page, here's sort of the ground rules. When I say investment, I'm including land. If your site is leased, I'm capitalizing your rent. I'm generally using about a 10 multiple. I'm just generally taking your rent times 10. I'm not including your common area maintenance and things like that. But I'm trying to create a rule of thumb that to get people that buy and people that lease to be able to compare to each other. I include startup and pre-opening, whether GAAP or tax. Wherever GAAP or tax puts it, I don't care. From an economic standpoint, I consider that an investment. For sales, it's after comps and discounts. I've been around and around for 30 years on this. Do I look at it gross? Do I look at it net? My opinion is you will probably look at it one way or another because it gets you the result you want. Gets you the better answer, not necessarily the real answer. But again, I have to be able to compare pizza to quick serve to fine dining, and we chose to use net. Cost of sale does include paper. For those in the fast casual, quick serve, and pizza, that's primarily where this comes into play. We're talking about the paper that touches the food. We're not talking about the paper in the copy machine. Labor, it's fully loaded. We include taxes and benefits in there. Taxes and benefits tend to run around 20% in the industry. So if your labor without taxes and benefits is about 25% of sales, if I take 25% times 20%, I get another 5% for taxes and benefits. That rule of thumb has really held pretty steady for a while. G&A and home office, our definition is everything above the store. Your regional managers are in G&A. Right? So anything above that store, if they don't work in the store, they're G&A. We kind of designed the way we look at restaurant companies all around what we call the ROI model. And what we've done is we've taken the definition of return on investment, which is really return divided by investment, but we've expanded it out. I think in the old days it was called the DuPont model or something like that if you're an MBA. So we look at sales to investment times return on sales times leverage, and that gives us our ROI. Or mathematically, you can see that sales is in the numerator and the denominator, and they sort of cancel out, right? Why do we do it this way? We do it this way because each of these can have a significant impact on the return on investment. At the end of the day, that's really what this business is all about. For you owners in the room, I know I'm not telling you anything you don't already know. Return on investment is what it's been all about. For the non-owners in the room, there are a lot of different ways. I mean, this is an industry full of measurements and full of percentages. One of the things I was asked pretty early on was, well, how should we be measuring success? What's the number? If we had to pick one thing, what is it? Thought about it. Kind of went back to the old college textbooks, and up popped the answer. Return on investment. Creating that return is really what it's all about. Because after all we really are shepherds of capital, and getting that return on capital in the form of a restaurant is what we're hired to do. We also look at it this way. So not only are these each an important component and a different component, but the responsibilities are different. Who's responsible for the use of capital? That's generally the owner and the high-level executives in the company. They determine where the sites are, how much the investment's going to be, all those kind of upfront big decisions. Who's responsible for operating margins? Well, that's generally operations. Right? So while each has a very important piece of the return on investment equation, the responsibility is totally different. So CFOs might have a significant responsibility for the use of capital piece, but probably less of a responsibility for the operating margin piece. And certainly CFOs have a big role in the leverage piece. And we'll talk about the leverage piece as well. So all three really can contribute. And what we found in our surveys over the years is for the highest ROIs in the industry, it requires all three to really be firing on all cylinders to do it. We've often said if you do 1 out of 3 good, very hard to survive. Do 2 out of 3, and you're pretty much a survivor. You're an average restaurant company. Do all 3 is when you start hitting home runs and grand slams. We're going to go into more benchmarking than this, but I think you might agree that a successful restaurant company, and I've got an ulterior motive here, if you'll bear with me a minute. Successful restaurant companies, P&L might look something like this. Prime costs somewhere around 60%, operating expenses around 15 to 20, add in G&A overhead, and there might be a return on sales. I used EBITDA in this situation. The R is rent. So this is a return before rent of around 15 to 20%. Okay? I think we'd all agree that's pretty successful in this business. Well, just mathematically, if you remember back to the ROI formula of a couple slides ago, if it's sales to investment times return on sales equal return on investment, if the best I'm gonna do is 15 to 20, which is this, then the only way I can get this of at least 15 to 20 is if my sales to investment is at least 1, right? Because if that number on the far left there is a 0.5, I can get all the margins in the world. My ROI is still going to stink. If I have a great sales to investment and my margins are low, my ROI will stink. So both play a very important role. My point in this is the importance of the sales to investment ratio of at least 1. If you can't efficiently use your capital, you're going to have a hard time, no matter what your margins, making a good ROI. Here's where sales to investment ratios have been. 10 years ago, they were all well over 1. In recent years, many of them have, some are still above 1, and some have fallen below 1. And again, when you fall below 1, very hard to get that 15 or 20% return on investment. If you don't get the 15 to 20% return on investment, you're not going to get guys like Morehead Capital wanting to invest in your business. Or your owners will find other use in their capital. So they've declined, and I'll show you some more examples in a moment. But this is something that I calculated, an incremental column, and I think that's kind of interesting. This is what it shows. It's sort of the flow through on the sales to investment. So while, say, McDonald's fell from 1.2 to 0.9, if you look at just the change in the 10 years, not where they're at after 10, but the change during the 10, it's actually 0.7. And you can see by looking down the list, some people's use of capital has just been terrible. Say Applebee's. So what that's essentially saying is, when we increased the cost of building an Applebee's, we didn't get anywhere near a 1 times more sales for that cost we invested. So if we increased the cost to build an Applebee's over 10 years of $1 million, let's say, we didn't generate $1 million more sales. We only generated 300,000 more sales. So that incremental use of more capital, we've gotten very bad at. And that's a lot of what's happened in the industry.
Well, Brad, capital costs are a lot lower than they were 10 years ago, or 20 or 30 especially. Wouldn't that factor into this?
The question is that capital costs are lower, shouldn't that factor in? I'm assuming what you mean by capital costs is the cost of finance.
Yes.
And the cost of finance is a factor, it's the leverage factor. So in my mind, because capital is cheaper today, and we all have roles as CFOs to determine how much debt our company should have, let's talk about how we manage that aspect separately. Let's not make a bad investment decision because the capital's cheap. So we break it out saying, first we got to make sure we're using our capital wisely. Then we'll decide what the best use of debt versus equity is. Let's not justify a good or bad capital decision.
I'm just thinking competitors and users.
Oh,
You know.
yeah. My point in this is that this doesn't mean we have all really stunk at our jobs. Some probably have stunk at their jobs, but it really means that as the industry has gotten so big and competitive, I mean, there was a time when you just didn't have all these restaurants like you do today. Many of you are very young, you really don't know any better. But there was certainly a time when I was growing up, we didn't go out to eat. So a lot of this is just a reflection of the competitive nature of the game. In order to compete in the game, you have to spend more capital. And we've, to some degree, it probably reflects overgrowth. We've grown to a point where the next location we should have done, that kind of thing. Because this is essentially saying those last dollars we spent were really kind of not spent wisely. Or we had to spend them to compete, but they've taken a big impact on us financially. Here's kind of how things look. The overall industry today is about a 1-to-1 sales to investment. And that's about where the industry's at. Back about, almost 10 years ago, the industry was at 1.2. When we first started doing our surveys, we found most restaurant companies, the average was about 1.2. It fell to about 1, and it's been there about ever since. New builds are even lower. Our survey is based on historical. In fact, I'll give you a good example here in a minute if you want. Here's how it breaks out among categories. It's very driven by price point. Obviously, upscale casual generates the highest sales. They're going to have the highest sales to investment. High quartile companies, in our surveys, we define them as the top 25% performers. And pizza has really, chain pizza has converted to primarily a delivery model. The use of capital in the pizza business is pretty efficient these days. It doesn't cost very much to open a Papa John's. This is an interesting example. This comes from restaurant research. And by the way, if you don't get restaurant research, I really recommend you do. It's restaurantresearch.net. .net, and we've subscribed to this service now for years. I always sing their praises here at boot camp. I think there's actually a slide with their web address on it, but they do tons of great restaurant research. This is pretty typical examples. These are all very recent of what it costs to, and this is without land, by the way. What it costs to build a Fridays, $2.8 million, versus the cost to go out and buy an existing Fridays at, say, 5 or 6 times EBITDA. As you can see, it's about half. So what incentive? So in my mind, all this is a reflection of this. And most of the chain industry hasn't really experienced much growth now for quite a while. We open new stores, but we close just as many stores. So the real success in the industry has primarily come from this model. Our clients going out and being able to buy stores at a 5 multiple, as opposed to buying stores that are very expensive to build. If you look at the quick serve industry, and then there's the Jimmy John's guys here, and you pull out Jimmy John's and Subway, there hasn't been growth in a decade. No growth at all. Casual dining's been very similar. This is the reason. Again, a lot of examples, but you can see that certainly the cost to buy existing is way cheaper than the cost to build. Maybe it's sort of the natural order of things because it's gotten so expensive to build, and better mousetraps will come along, and in the world, we'll probably sit here at the boot camp 20 years from now, probably on a crutch or something. I'll come in a walker, and we'll talk about, gee, remember Applebee's? Remember this? Trust me, if you go back and look at the change from 20, 30 years ago, they're not around, most of them. We track the commodity costs, and when I first did this, I thought, God, this just can't be right. But actually, commodities, even with some of the recent press you've heard, have really still have been relatively tame now for a while. And you're going to see when I show you the first quarter benchmarks that the impact that the commodity costs had wasn't actually that significant on the benchmarks that we track. And the benchmarks that we track are primarily the publicly held companies. And we've always felt like our comparisons of our clients who are primarily privately held to the publicly held companies is the publicly held companies have tended to be about 2% or so better than most of the private companies at managing their costs. But I think a lot of the reason is because a lot of this has occurred, I guess, in April. And so the first quarter really wasn't, it's not being reflected yet. But you'll see in a minute, cost of sales really hasn't spiked. Maybe the other thing to point out is that I think the industry has done a much better job in recent years of adapting to the commodity price volatility. Wasn't that long ago when raising prices was something that seemed like there was such a hesitancy to do. And I think we're beyond that paradigm right now. Chipotle announced they're going to raise their prices to keep up with their increase in commodity costs. Can't remember, somebody else comes to mind that also announced they were going to do the same thing. So really what we're doing is we've lost that hesitancy to raise prices to deal with commodity costs. And I think that's really been the main driver of our margins remaining intact. We've now had basically about a little over 3 years of same-store sales increases every quarter for 3 years. Although the last 3 quarters have shown the biggest declines. And the overall industry in the first quarter of 2014, which is the lighter shade on the right, was the lowest we've seen in 3 or 4 years. It was about 0.5% positive for the entire industry. But there are 3 or 4 companies that are driving that to look better than it probably really is. Chipotle was, I think, 13-point-something% same-store sales increase in the first quarter. Papa John's was 9.6, I want to say. In the casual, BW3 and Red Robin have been really bright spots now for some time, while most of the casual segments have really been suffering. It's hard to, you can't just look at this and probably say, gee, everybody else is doing that, why can't we? Because I think a handful of players are really skewing the numbers. But here they are, and they've pretty much looked this way for a while. QSR's been kind of positive, didn't feel the effects of the recession as much as other segments. Not the glory days, they're not bad either, just kind of keep churning along. Fast casual's clearly been the winner. Never went negative, always been in that 3% range or higher for many, many years now. Pizza has really reinvented itself into the $10 large pizza or even cheaper. We're kind of seeing it on the margin, just see that in a minute. But pizza has found a way to make a profit at a $10 pizza.
Are you including all like the new artisan pizza?
No. These are just 4 or 5 major chains. Casuals really taking a licking now for quite a while, and upscale casual probably looks on the page better than it is because it's not really even back to where it was. It's close. It's about back to where it was 2007, 2008. So while it's shown some pretty big same-store sales increase, it's easier when you're comparing to crappy numbers. Boy, we're really running behind. Prime costs are your cost of sales and your labor. We have always professed that around 60% is the key to good margins in the restaurant industry, the sum of your cost of sales and labor. They've tended to go up and down over the years, labor going up and the cost of sales going down and vice versa. But here they are by segment. And here's the overall industry in 2013 and 2014. Again, these are public company comparables. And you can see that margins have been pretty tight, not really going significantly up or down. You'll see it in most segments here. Pretty much the same. Pizza was the one that I said really cost of sales being up to 31.7 because of the cost of cheese and the price of the pizza has finally really pushed cost of sales above 30% pretty consistently for the big chains. You talked about the artisan pizza types. For most of our clients that are in the independent space, their cost of sales were never really in the 20s for some time now. It's been a really struggle. They are all around the 32, 34% range. Here it is for casual and upscale. One of the things we've done in our studies is kind of bring this whole thing together for you. So we've taken the margins, we've taken the sales to investment, and we've kind of compared independent and franchise. And in recent years, really ever since the recession, the franchise group's actually come out a little better than the independent group. 15% line, that's sort of our benchmark that we put in there. The unfortunate thing is, as you can see, most of the industry's below. So what do they do since they're below it? They borrow money because capital's cheap. We have found that the franchise space can borrow significantly more than the independent space. For those in the financial world, I'm not telling you anything you don't know. It's easier to borrow money as a franchise. What we've done is we calculate the unleveraged ROI, and you can see that it's kind of gone down a little bit over the years as the recession has taken its toll. And then we calculate what we call the leveraged ROI. And the leveraged ROI says, my investment is not going to be the total cost of that investment. It's only going to be the equity piece I have to put in. And my return is not going to just be the cash flow of the restaurant. It's going to be the cash flow of the restaurant after I pay back debt. All right? And we rework it. And so we've reworked it. And then we sort of fudged a line in the middle and call it the leverage factor. Basically, that's just saying leverage has been a benefit to my returns by a factor of 50% back in 2007 and now about 20% today. So what we found, and this should be intuitive to you, is that as things got tough during the recession, leverage worked against us. It didn't provide the benefit it once did. So while it provided a big benefit, it's now not providing as much benefit. Or said another way, while these returns have fallen around 20% or 17%, this has fallen 35%. So leverage works both ways. We also surveyed those companies that we felt, when we reworked our leverage calculations, if the cash flow turns negative, then we consider them unable to service their debt. And what we did is, for all those companies that went negative, we started looking at their level of debt to their total capital. And we found that 75% is a pretty good benchmark. Now, once your leverage gets more than 75%, your risk of being unable to service debt goes up dramatically. Stay below 75%, it drops a lot. That doesn't mean 74% is okay and 75% is not. It's just an approximate. We think once, and really, your bank covenants and other things really should restrict you from getting that leveraged anyways. But once you start borrowing more than 75%, we think it's a level of leverage that we think, when we surveyed companies, we found that the percent that were unable to service debt was very high. I don't think we show the percentage there, we once did, but I think it's about 35%. It was a very high number. This is the way we like to manage debt, or we suggest you do. We suggest that we start with what's known as the FCCR, the fixed charge coverage ratio. And what you're doing is your numerator is your cash flow before debt, and your denominator is your fixed charge, your debt repayment. And we recommend a 1.5, which basically means that if you calculate, you can do this a bunch of different ways, you can calculate what your cash flow is, divided by 1.5, and that tells you what your comfort level should be with fixed charges, your principal and interest repayment. We suggest a 50% cushion. And while 50% may sound really conservative, it's not. It would not take much in the change in sales or margins to wipe that out entirely. So in my mind, it's a very reasonable, not overly conservative cushion that we would highly recommend. And it equates to a sales cushion of around 12.5% and a margin cushion of 5%. For those that were really astute in the flow-through thing here, 40% of that number is 5%. So that's how we sort of arrived at sales of 12.5%. For those that have debt covenants, most of you probably do, that's what it works out to. And it does require more equity than we're used to. But in our mind, in our experience, this is the level of debt we think that's appropriate for most companies, at the most. And of course, a lot of it depends on your philosophy about debt and other kinds of things. But in the industry, it's always been historically a heavy user of debt. It's been the way we've gotten decent returns. Nothing to get too excited about 11% return. So if we don't start spiking it up closer to 15 to 20, then capital's not going to seek its way into our industry. I mentioned restaurant research. Oh, it says .info, but I think I thought it was .net, but anyways. It's you either try .net or .info. I also use GE's Restaurant Industry Review, and you can get it online. And SEC.gov is a great source to go for public company filings, although I just go, every public company I go right to the website. Get any filing you want. And these are the basic sources we use for all of our benchmarking data. Sort of out of time, so I'm just going to run through this extremely quickly, and I'll leave the model up to you. So as you run projection models, a couple of hints for you. Keep it simple, or as you run ROI and stuff, keep it simple. Sometimes something that is really simple and easy, even though not perfect by Harvard MBA standards, is still a lot better. I've always felt like if I didn't present something to the owners of the company that they actually understood, it could be the most technically correct thing in the world, but it doesn't matter. I had to provide them something that they understood that would still get us to the right place. So I used ROI. My calculations were different than what I taught you today, and they weren't technically correct. But it still got us to the right place. And I did it in a way that I felt like our owners understood. So for example, we did not capitalize rent. Our owners didn't understand the whole concept. I said, fine, then we won't do it. I don't care if it's technically correct, as long as we do it that way for every store, and that's what we're used to, great. If it helps us make better decisions, great. This is the actual model I used at Houston's. We did a couple unusual things. The big unusual thing is, in our return number, we actually subtracted out maintenance CapEx. We subtracted out 2% of sales. I'm sort of out of time, so I can't go through the whole thing, but you can kind of study it on your own, and I think it'll make some sense to you. But we actually subtracted out 2% of sales and said, that's actually an expense because we're going to incur it. If we don't incur it this year, we're going to incur it over time. So anything that you incur over time sounds like an expense to me. And then when it came to our investment is, we backed out that same 2% of sales, because if you include it above, you can't include it below, or you're double counting. And that's sort of the model we use. And we ran that for every store every year, and there was one way for us to track what our ROIs on the stores were. We can talk about it. Is our remodeling paying off? If you see the ROI for every store every year, then you can start seeing if the remodel done in 2008 was finally starting to pay off in 2010, say. That kind of thing. Final observations of this. In order to get a sales to investment of about 1, you're going to have to do sales per foot of about $400 to $500, if you want to think of it that way. In order to get margins of 15 to 20%, you're going to need prime costs of 60% or better, and you're going to have to keep your G&A to about 5%. Use debt wisely. We recommend starting with your fixed charge coverage approach. Figure out what your cash flow is. Let that dictate how much debt you can take on. Or alternatively, if you've got a certain amount of debt, using 1.5 will tell you what kind of cash flow you need to feel comfortable. And it equates to a leverage of about 60 to 75% max. In our surveys, we found that while the average company had an ROI of 11%, the high quartile, the best companies in all these categories, really had an ROI of more than double that. So really, firing on all cylinders in the ROI model, you can really generate, still to this day, some really good returns. Are we taking 15 minutes?
We are.
We're taking a 15-minute
A
break
quick one.
until about, how about 5 after 3? And we
Okay.
won't be too far off.